There are many different investments out there. Where do you even start? This is What are Mutual Funds and Index Funds with Basic Finance. When you have a brokerage account, IRA account, or Roth IRA account, you are able to buy different investments. Two extremely common investments are mutual funds and index funds. But before we jump into mutual funds and index funds, let's do a quick stock market recap. So in the stock market, you are trading shares of ownership in various companies. You want to buy these shares low and sell them high, obviously. And the greater the risk, the greater the reward, and vice versa. I want to focus on this third point for a second, the risk and reward dilemma. The higher the risk in an investment, the higher the reward, or the harder the fall. There are some daredevils out there who really like to try their luck picking stock, and some of them are pretty good at it, but many people want a way to minimize risk while still earning a modest reward. The most common way of minimizing risk is by diversifying your portfolio. The term diversifying your portfolio is basically just fancy speak for don't put all your eggs into one basket. And that is where mutual funds and index funds come in. Mutual funds are simply where a group of financial experts take the money invested into the mutual fund and diversify the portfolio in return for a fee. Here's an example. Let's say that Joe's mutual fund is available to buy on the stock market for $100. So I decide to buy 10 shares for $1,000 total. Joe then takes this $1,000 that I invested and all the other money from the other investors and decides to invest some of it into Microsoft, some of it into Apple, some of it to Google, and so on. By doing this, you are minimizing your risk. Then, depending on how Joe's investments do, the price of the mutual fund will either rise or fall. The biggest pro about mutual funds is that they help diversify your portfolio, and if you select the right mutual fund, it can be managed by a qualified individual and can make you a great return. The downside, though, is that those who manage mutual funds take a portion of the earnings by charging a fee. So, now that we know mutual funds, let's move on to index funds. But in order to fully explain index funds and how they work, you need to understand that there are certain metrics given that let investors know how the stock market is doing as a whole. These metrics are known as indexes. Three of the most well-known indexes are the Dow Jones Index, the S&P 500 Index, and the NASDAQ Composite Index. The Dow Jones Index is made up of the stocks of 30 different large companies from varying industries. Think Apple, Boeing, Walmart, Visa, those types of companies. The S&P 500, or Standard & Poor, consists of 500 large companies, and the NASDAQ Composite Index consists of around 3,000 stocks, and it is weighted so that the larger companies have a bigger impact on the index. Overall, these indexes allow for an investor to simply look and say, oh, the S&P 500 is up 5% today. And based off of that metric, you can know that the market as a whole is generally doing well. So when you buy an index fund, you are essentially just buying into many different companies at once, as index funds simply mirror an index. This is where index funds are different than mutual funds, since index fund managers simply follow the chosen index, whereas mutual fund managers do not. Index funds appear by some to have less potential for reward, but others prefer them since they have lower fees than mutual funds. I hope that you guys enjoyed this video. Don't forget to comment below on any future video topics you would like us to cover, and we will see you next time.